Hello, everyone. This is Dr. Kenneth Ta. Today, we are going to consider Chapter 9. Chapter 9 is the cost of capital. This is a very important chapter because this concept is extremely important for companies. Companies always want to understand their cost of capital. They need money to finance their operation, so they need to be able to raise capital. But you see, capital is not free. There is a cost that is attached to capital. If you were to go to the bank and ask for money, and the bank gives you money, they will ask you to pay with an interest. So that interest, you can see it as the cost of you getting money from the bank. So there's a cost of capital. So companies want to understand their cost of capital. In this chapter, we are going to consider the different components of capital. So that include debt. Companies get money from debt financing. They also get money from preferred stock financing, and they get money from common equity financing. So we are going to calculate, we'll be interested in calculating the cost of debt. We'll calculate the cost of preferred stock. We'll also calculate the cost of common equity. So once we do that, we need to understand the overall cost of capital. So we are going to take the different proportion of debt, the different proportion of preferred stock, the proportion of common stock, and we'll calculate the weighted average cost of capital. So of concern in this chapter is the computation of WACC, which is the weighted average cost of capital. So we are going to learn how to calculate the weighted average cost of capital. So WACC is very important, the weighted average cost of capital, number one, because it helps companies to calculate the value of the company. They can calculate the intrinsic value of the company. If they are using the free cash flow method, then they need to calculate the present value of all free cash flow and they sum them up. And in calculating that present value, they need R, the interest rate. So WACC is used as the interest rate in calculating the present value of free cash flow and then sum them up. So it's important for companies to understand their weighted average cost of capital because they use it in calculating the value of the company, the intrinsic value of the company. But WACC is also used in investment decision. So once companies understand their cost of capital, they are going to use that in making decisions in projects that they need to invest in. If it costs the company, say 10% in getting capital, then when they need to invest in any project, they need to ensure that that project is generating an amount that is greater than 10%. So if that project generates an amount that is greater than the cost of capital, then that project is going to be profitable. So think of it in this way. You go to the bank and you get money and you need to pay an interest rate. That interest rate is 10%. You need to invest that money in a particular project. You want that project to be able to generate greater than 10% so that the project is going to be profitable. If it generates something that is less, you will not want to invest in that project because you are going to make a loss. So the weighted average cost of capital is used in making investment decisions, and it is used in calculating the intrinsic value of the firm when we use the free cash flow. All right, what types of long-term capital do firms use? So when we talk about long-term capital, we basically, we are talking about long-term debt. And we are also talking about preferred stock, and we are talking about common stock. So those are the three long-term capital that firms generally use. There are some firms that will use permanent short-term debt. There are others that will use temporal short-term debt for seasonal fluctuation in inventory. But these are not usually considered as part of the capital structure. So capital structure will strictly be long-term debt. It will be preferred stock, and it will be common equity. Capital components. Capital components are the sources of funding that comes from investors. The sources of funding that comes from investors. So there are other fundings that don't come from investors. We don't consider them in the calculation of the cost of capital. It could be funding from accounts payable, from accruals, from deferred taxes. These are not sources of fundings that come from investors. So as a result, they are not included in the cost of capital. So usually we do adjust for these items when calculating the cash flow of a project, but not when calculating the cost of capital. So we have what we call before tax capital costs and after tax capital costs. And why we do this is because in understanding the cost of capital, especially the cost of debt, we need to adjust for tax benefit, When a company uses debt as a means to finance their operation, there is a certain tax benefit that is associated. They tend to pay less taxes. You know, if we look at the income statement, we'll come to a place where we have earnings before interest and taxes. Then we need to subtract interest. Once we subtract interest, we have earnings before taxes. It is this earning before taxes that we calculate the tax amount so that we can subtract taxes. So this is going to be a much smaller amount because this company has a certain amount of debt. You know, everything being equal, if we think of a company with no debt, then they are going to have earnings before interest and taxes, but they don't have any interest. So they are going to subtract their taxes, and this subtraction is coming from a much larger amount. The computation of taxes is coming from a much larger amount. So here, the computation of taxes is coming from this, that is going to be smaller. It's going to be coming from earnings before taxes, that is going to be smaller because of the subtraction of taxes. So for a company that has some debt compared to a company with no debt, there is the tax advantage. So we will expect that this tax for a company with debt is going to be lower. So which means that when we are thinking about the cost of capital, we need to take the tax benefit into consideration. So we'll calculate the cost of capital before tax and the after-tax capital costs. We have historical costs, and we also have new costs, which is marginal costs. So historical costs is the cost of debt previously issued, whereas new cost is the cost of new debt. So the cost of capital is used primarily to make decisions which involve raising and investing new debt. So we should focus on marginal costs. We should focus on marginal costs. So now we are going to start trying to understand the different capital structure and how we calculate the cost that is associated with those respective capital structure. So the first is the cost of debt, the cost of debt. There are three ways we can calculate the cost of debt. And remember that cost is really that interest, which we have used R, or we can use I. So R for cost, because it's interest in time value of money, we are using R. So we can put RD to represent the cost of debt. And of course, we can use RP for cost of preferred stock, RE for cost of equity. All right, so there are three ways we can calculate the cost of debt. The first method is to ask an investment banker what the coupon rate will be for the new debt. And we can infer that on the new debt. You know, the second is to find the bond rating for a company and use that yield on other bonds with a similar rating. So if the company is issuing bonds, that is debt financing because they are getting money from the public. Based on the rating of that bond, the cost of the debt they issue can be similar to the yield of a bond with a similar rating. So in that way, a bond with a similar rating can help a company to understand their cost of debt. The third method is to find the yield of the company's debt. To find the yield of the company's debt. So we are going to look how this can be done. So this is an example. This is a 15 years, 12% semi-annual bond that sells for 1,153.72. So the question is, what is the cost of debt? What is RD, the cost of debt? So given this kind of problems, we had seen how we calculate bond price before. So we can basically isolate R, and that is going to be the cost of debt. Or we can use the financial calculator. We can use the financial calculator. So if we are using the financial calculator, then we just need to input the things that are given, and then we press compute I/Y, which is yield. So the things that are given, this is a 15 years bond, and coupon is paid semi-annually, which means that we need to adjust for N, and 15 years, since it is a semi-annual coupon is going to be paid twice, or dividend will be paid twice a year. So we are going to end up with a 15 payment. So N is going to be 15 times 2, which is 30. So using the financial calculator, we'll take 30 and we'll type N. The bond sells for 1,153.72. So that is the present value. And we have the future value as well. So one of them must be negative. So we'll take negative 1,153.72. And again, we are using the financial calculator. That is going to be present value. Then we need the payment. So this is a bond, so there need to be coupon payment, which is 12% of 1,000, but we divide by 2 because our payment is done semi-annually. So when we do that, we are going to have 60. So this 60, we'll type 60, and then payment in our financial calculator. We know that since this is a bond, there is the 1,000 face value or par value that will be paid back at the end of 30 years. So we are going to take 1,000 as future value. Then we press compute I/Y. So that is what we are interested in, which is the interest rate. So once we do that, I/Y, the calculator is going to give us 5%. But we had formatted everything in such a way that it is semi-annual bond. So we are going to take that 5% and we multiply it by 2. So the cost of debt is going to be 10%. The cost of debt is going to be 10%. All right, so that is what we do if we use the financial calculator, and that is going to be helpful. We can use Excel to calculate I/Y, which is the interest rate. So once we calculate that, that is the cost of debt before taxes. We need to always make adjustment to get the cost of debt after taxes. So the cost of debt after taxes, after tax is going to be equal to the cost of debt before tax times 1 minus tax. So if we are given a tax of 25% for this company, then we can calculate the after-tax cost of debt. So the after-tax cost of debt is going to be the cost of debt before tax, which we just calculated, which was 10%, 1 minus 0.25. And that is going to be 7.5%. So we notice that the cost of debt after tax is much smaller than the cost of debt before tax. Again, because of the tax advantage that is associated with the use of debt. All right, so that is the first thing, which is the cost of debt. The second thing that we want to look at is how to calculate the cost of preferred stock. We have seen how to calculate the cost of debt. Now we are interested in calculating the cost of preferred stock. So this is an example that is given. In this example, the price of preferred stock is $116.95, and the dividend that is paid is 10%. And then the par value is given as 100. Then F is what we call flotation cost, which is 5%. Flotation cost of 5%. So in the issuance of preferred stock, there is flotation costs that we need to take into consideration. So preferred stock, flotation cost is the cost associated with the issuance of stock. So companies need to pay administrative fee, they need to pay lawyers fee, which means that they need to pay investment bankers. So if a stock is selling for a particular price, we need to get the net proceed. So that we can look at that price as the money that comes to the company. We need to subtract flotation costs. Once we subtract flotation costs, then we end up with the net proceed. We end up with the net proceed, and that is what we are interested in. So the net proceed, or the price, and of course, if this is preferred stock, is going to actually be the price 1 minus the flotation cost, the flotation cost. Say if in this example, this stock is selling for $116.95, it means the net proceed is going to be less the flotation cost. So we'll take the 116.95 minus 5% of that 116.95. And the way we do it is just to say the net profit is going to be the price times 1 minus the flotation cost. So once we take flotation costs into consideration, we can easily calculate the cost of preferred stock. So this comes from what we had done before, from the price of preferred stock. So before we had said the price of preferred stock is equivalent to dividend minus interest rate. Dividend minus interest rate. So this price is really the net proceed. So we need to subtract flotation cost, which is what we want. Price times 1 minus F, that is going to be dividend divided by R. We are interested in this R. So this is R of preferred stock, which is going to be D over price 1 minus F, 1 minus F. So that is the formula that will be used in calculating the cost of preferred stock, the cost of preferred stock. So the cost of preferred stock is the dividend of the preferred stock divided by the net proceed. Or we can say the dividend divided by price times 1 minus flotation cost. So everything is given. We are told in this problem that the dividend is 10%, and it is 10% of par, which is the face value. So 10% of 100 divided by the price, which is 116.95 times 1 minus the flotation cost, which is 5%. And if we work that out, we end up with the cost of preferred stock, which is equivalent to 9%. So the cost of preferred stock is equivalent to 9%. So some of the things we are seeing is that flotation costs for preferred are significant. Flotation costs for preferred are significant. So we take them into consideration in the calculation of the cost of preferred stock. Okay. Another thing we need to take note is that preferred stock is usually more risky. So we can ask a question: is preferred stock more or less risky to investors than debt? So the answer is that preferred stock is more risky. So accordingly, the cost of preferred stock is going to be higher than the cost of debt. And that's what we are finding. So we had looked at the cost of debt before, the cost of debt even after tax. And if we go back, the cost of debt after tax, we had 7.5%, but the cost of preferred stock, we have 9%. So when investors invest in preferred stock, because it is more riskier than debt, they are going to demand a higher compensation. So accordingly, the cost of preferred stock is going to be higher than the cost of debt, because preferred stock is more risky than the issuance of debt. Okay. So we just answered that. Why is the yield on preferred lower than the yield on, why is it lower than the yield? Why is the yield on preferred lower than the yield on debt? So that's when we didn't consider taxes. So without taxes, the yield on preferred we have seen is 7%, but the yield of debt before tax was equivalent to 10%. So taxes were not taken into consideration. But once we take taxes into consideration, the yield of preferred we see is 9%, which is greater than the yield of dividend of debt after tax, which is 7.5%. 7.5%. Okay. All right. So we have seen how to calculate the cost of debt, and we have seen how to calculate the cost of preferred stock. We want to go to calculating the cost of equity. The cost of equity. What are the two ways that companies can raise common stock? They can raise common stock directly, and they do this by issuing new shares of common stock. They can raise common stock indirectly by retained earnings, which is holding back on money that they were supposed to pay common stockholders. So investors could buy other securities and in return. So once there is retained earnings, there is also an opportunity cost that is attached to it. So the cost of reinvested earnings or retained earnings is what we call the opportunity cost. So the cost of stock is the cost of reinvested earnings, and it is the cost of common equity. All right, so there are three ways that we are going to calculate the cost of equity. The first one is using capital asset pricing model, which we have seen it already. The second one is the discounted cash flow. I believe we have seen it from the perspective of calculating the price or the value of stock using the dividend model. So in this case, we basically make out the subject. And then the third one is cost of equity. It's basically using the cost of debt, and then we add risk premium of bond, because the cost of equity is going to be greater than the cost of debt. And what makes it greater is going to be the bond risk premium. So there will be a use of a certain judgmental risk premium. So we'll call this own bond yield plus judgmental risk premium. It's another way we can calculate the cost of equity. All right, so the first one is using capital asset pricing model, which is CAPM. Again, we have done this so we can refresh our memory. This is capital asset pricing model where we have this required return, which is the cost of equity that we are interested in. We start with the risk-free rate plus the risk premium, market risk premium, times the company's beta coefficient. So given this example above, where we have a risk-free rate of 5.6%, market risk premium of 6%, and the company's beta coefficient of 1.2, we can calculate the cost of equity by using the capital asset pricing model. So we just feed in, and here we have the risk-free rate, we have the risk premium, we have the beta coefficient. We add all of that, we multiply and add all of that. We end up with the cost of equity being equivalent to 12.8%. So it's 12.8%. All right, so that is one way that we can calculate the cost of equity using the capital asset pricing model. So most analysts use the rate on long-term debt to calculate. They use the rate on long-term government bonds to estimate the risk-free rate. So we need that risk-free rate, and for most analysts, they will take the rate on long-term government bonds. See, government bonds, because government will always make good on their promises. So the government bonds are assumed to be risk-free. So if we want to look at the risk-free rate, then it will be the yield of government bonds. Issues using capital asset pricing model. Most analysts will use a rate of 5.3 to 6% for the market risk premium. So they also need a market risk premium. The estimated beta coefficient can vary. So as a result of that, it can be noisy. So those are some of the issues that are associated with CAPM. Okay. So that's the first way of calculating the cost of equity. The second method is using the dividend growth model, where now we isolate RS as the cost of equity. So when we had looked at the dividend growth model before, we're interested in calculating the price at the moment, which we said it was D1 over RS minus G. So now we are interested in the cost of equity. So we are basically making RS the subject. So we multiply both sides by RS minus G and divide both sides by P0. So we have RS minus G is equivalent to T1 over P0. So RS, which is what we're interested in, is D1 divided by P0 plus G. So this is the formula for calculating the cost of equity. So it's the dividend growth cost of equity. So given this formula and the example that is given, we are told that D0, which is the dividend right now, is 3.26. The price is $50 per share. G, which is the growth rate, is given as 5.8. We are interested in calculating RS. So notice that this D1 is equivalent to D0 times 1 plus G, because dividend is growing from D0 to D1 by G. So now we have everything that is given. We basically fit for D0, which is given as 3.12. We fit in G, the growth rate, which is 0.058. And then we feed in for the price right now, which is $50. And we feed in for G, which is 5.8. And then we work that out, we will end up with the cost of equity, which is going to be equivalent to 12.4. So it looks very similar, but it has some variation with the cost of equity that we calculated using CAPM. When it was CAPM, we had 12.8. Now we are using the dividend growth cost of equity, and we have 12.4. Okay, so estimating the growth rate, it could also be a task to undertake, because it doesn't come easy. In this example, we are given a growth rate of 5.8. But how do companies estimate this growth rate? They can use historic growth rate if they believe that the future will be like the past. So they look at the growth rate in the past, and they can use that in calculating the cost of equity. They can also obtain analyst estimation using analyst site like Value Line, Yahoo Finance, and so on and so forth. And then they can use the earning retention model that we are going to see how that is calculated. Okay. So with the earning retention model, they're interested in understanding the return on equity of the company, and then what is the retention rate? And the retention rate is basically 1 minus the payout rate. So if they have that, then they can easily calculate for G, which is that growth rate. So suppose a company has been earning 15% on equity. So return on equity is equivalent to 15% and has been paying out 62% of its earnings. If this situation is expected to continue, what's the expected future growth? What's the expected future growth? So the earning retention model in calculating G, the growth rate, it is basically the retention rate times the return on equity. And the retention rate is 1 minus the payout rate, So everything is given. The payout rate is given as 62%, and the return on equity is given as 15%. So we can basically plug this out, and we will have G, which is that growth rate. And it is close to the G that was given when we're solving the cost of equity. G that was given was 5.8. So if G is not given, and we have the retention rate and the return on equity, we can calculate G. Or if we have the payout rate and the return on equity, we can calculate G. So that is how we calculate G using the retention method. Or G is given, or we can estimate G from the past growth. Yeah. So could the dividend growth approach be applied if G is non-constant? Yes, it could be applied. All right. One of the other ways that we can calculate the cost of equity, so we have said there are 3 ways. We have seen 2 ways of doing it. The third way of doing it is to use the own bond yield plus a certain judgmental risk premium. So if the return on debt, which is that bond yield, is given as 10%, and the risk premium is given as 3.2%, then the cost of equity is basically the cost of debt plus the judgmental risk premium. Because we expect that the cost of equity should be higher than the cost of debt. So at least we'll first take the cost of debt plus a certain premium for taking more risk, because equity is generally risky than debt. All right, so if we fit in what has been given, so the cost of debt is given as 10%, and the judgmental risk premium is given as 3.2%. That will mean that the cost of equity becomes 13.2%. 13.2%. So the 3 methods we have used tend to generate slightly different return on equity. So when we use capital asset pricing model, the estimated return on equity we had was 12.8. We used the dividend growth model, we have 12.4. And then we use the own yield plus judgmental risk premium method, we end up with 13.2%. So to have a fair value, we basically take the average of all three, which is going to be 12.8% plus 12.4% plus 13.2% divided by 3, and that will leave an average of 12.8%. And it's this 12.8% that we can use as the cost of equity or the cost of stock, which is RS. So companies can tend to use just one of this. They can use the CAPM method to calculate the cost of stock or the cost of equity, or they can use the dividend growth, or they can use the own bond yield plus judgmental risk premium method. But if they use all three, then they need to calculate the average of all three, and that will give us that RS, the cost of stock that they need. Okay. So once we have the cost of debt, and especially the cost of debt after tax, and then we have the cost of preferred stock, the cost of common stock, the last thing is to be able to bring all of them together and calculate the weighted average cost of capital, which is the WACC. Calculate the weighted average cost of capital. So we will need the weights in calculating the WACC. The weights are the percentages of the firm that will be financed by each component. We can also use the target weights. So if target weights are given, for example, the weight on debt is 30%, the weight of preferred stock is 10%, the weight of common stock is 60%. Then we can use this respective weights in calculating the WACC, which is the weighted average cost of capital. So once weights are given, the weighted average cost of capital WACC, we can call it RA, is going to be weight of debt times cost of debt, and the cost of debt that we use is the after-tax cost of debt. So this will be weight of preferred stock times cost of preferred stock plus weight of common stock times cost of common stock. So that is the WACC model. The WACC model, we are bringing the weighted average cost of capital. We are taking the respective cost of capital that we just calculated, taking their weight into consideration and adding them up. So if we have this target weights, then we can easily use them in calculating our WACC. If we don't know the target, then it is better to estimate the weight using the current market value than the current book value. So if we don't know the market value of debt, then it's reasonable for us to use the book value of debt. All right, so using the market value, so it is really based on the total investment that we have. And then we divide by investment in the different instruments that make up the capital structure. And that will give us the respective weight. So let's look at the company that have debt, and they have preferred stock, they have common stock, that builds up their source of capital. So if debt is selling for 1,153.72 and the company holds 7,000 bonds, then the market value of debt is going to be the price times quantity. So the price times quantity, price times quantity. So if we do that, then the value of debt comes up to 18,760,400. So it's approximately 18.76 million. So that is the market value of debt, the market value of debt. Now let's look at the market value of equity and the market value of common stock. So it's based on the price and number of shares. So the price of equity is $116.95. We have 200,000 shares, which means that the market value of preferred stock is going to be 116.95 times 200,000, which means it will give us 23,039,000, which is equivalent to 23.9 million. All right, so that is the value of preferred stock. And we can do the same to calculate the value of common stock. So if common stock is selling for $50 per share and there are 3 million shares outstanding, then the market value of common stock is going to be $150 million. 150 million. So we are basically taking price times number of shares outstanding. All right, why this is important, the market value, is because we can use it to calculate the weights of the respective investment. So the market value for debt for this company is 80.76 million, preferred stock is 23.3 million, and common stock is 150 million. So the question is, what is the total value? The total value is 254.6 million, all right? So once we know this total value, we can basically calculate the weight of the different component of the capital structure. So for debt, for example, the weight of debt is going to be 8.76 divided by 254.60. Which, if we do that, is going to be 31.79%. Weight of preferred, 23.3 million in preferred on 254.6 million. That is going to give us 9.17. And we can do the same for common stock. We want to get the weight of common stock. The value of common stock is 150 divided by the value of the entire capital structure, which is 254.6. That is going to give us 59.04%. So this is going to be the weight of debt, the weight of preferred, and the weight of common stock. We need that to be able to calculate the WACC, which is the weighted average cost of capital. So again, if the weights are not given, then we can estimate the weights. If we know the value of each component of the capital structure and the total value, we can basically just take the value of debt divided by total value to give us the weight of debt. And then we can also take the value of preferred stock divided by total value, the value of common stock divided by total value. Those will give us respectively the weight of preferred and the weight of common stock, the weight of common stock. All right, so now that we have weights and we also have cost of debt, cost of preferred stock, cost of common stock, we can calculate the weighted average cost of capital. So this is how we computed the weights before. Now we want to calculate the WACC, which is the weighted average cost of capital. So the weighted average cost of capital, again, is the weight of debt times the cost of debt. And notice that we are using the cost of debt after taxes. So we need to make that adjustment, which is cost of debt before taxes times 1 minus T. That will give us the cost of debt after tax. So it is weight debt times weight that times cost of debt plus weight preferred stock times cost preferred stock plus weight of common stock times cost of common stock. All right, so we have the weights that are given. Weights, and then 1 minus T, 10%. And then we do the adjustment for taxes, which is 25%. Then we take the weight of preferred times the cost of preferred. Then we take the weight of stock times the cost of stock. So once we work that out, that is going to give us this all-important number that we have been trying to calculate, which is the weighted average cost of capital. The weighted average cost of capital now is going to be 10.83. All right, so that is what we want to calculate. Some few things that we need to know. What factors influence the company's weighted average cost of capital? We have uncontrollable factors and controllable factors. So uncontrollable factors will include things like market condition, especially interest rates. Interest rates are going to affect the cost of capital. If interest rate is going up, the cost of capital is going to go up. The market risk premium is going to affect the cost of capital. If investors are becoming more risk adverse, they are going to be placing a higher demand, a higher return on their prospective investment. And all of that is uncontrollable. We've also seen that taxes come into play when we calculate the cost of debt. So tax hike, reduction of taxes, they are uncontrollable factors. Then there are certain controllable factors that influence the company's weighted average cost of capital. That include things like capital structure policy. Of course, capital structure policy, what percentage of debt, preferred stock or common stock is the company holding? That is capital structure policy. Something like dividend policy is going to be a controllable factor. The company can make adjustment. And then investment policies as well. Firms with riskier projects generally have a higher cost of equity as expected. Okay. So is the company's weighted average cost of capital correct for each of its division? The answer is no. Some divisions are big and so unique that even though they are part of a bigger umbrella, it is important to understand their weighted average cost of capital. So there need to be some adjustment that is made so we can get the risk-adjusted divisional cost of capital. So there are two approaches in estimating the divisional beta. As if we want to understand the divisional cost of capital. So think of a big company with different divisions. So that division within a bigger company, we might be interested in understanding what is their cost of capital. So one of the things we need is, especially when we use the capital asset pricing model, we need beta coefficient. So there are two ways in calculating the beta coefficient, two approaches used in estimating the beta coefficient for a division, or what we call divisional beta, the divisional beta. So the first way is the pure play method for estimating the beta of a division. So we find several publicly traded companies exclusively in the project's business. We use the average of their beta as a proxy of a project's beta. The limitation with the use of the pure play method for estimating beta for a division is that it could be hard to find such companies. Another way that we can estimate the beta is using accounting beta method. So in particular, we run a regression between the return on asset and S&P, which is the market index return on asset. So the slope of that is going to be our divisional beta. All right, so under normal circumstances, so the limitation with this method, is that normally can get data on a new project, return on asset, on a new project's return on asset. So it's difficult to get data on a new project's return on asset. But the capital budgeting decision has been made. So under normal circumstances, in calculating the beta coefficient, we basically are using market return, and then we run it with company's return. And we can have something like this. Then we estimate the slope. This will be the beta coefficient. So in this case, it is market beta. But for a division, we need the return on asset. So we need division return on asset, and we run that against return on asset for, say, S&P, which is the market. And then we'll have something like this. So the slope of this is going to be the divisional beta coefficient. All right, so in calculating divisional cost of capital, let's use CAPM. It's actually the same thing we do before in calculating the cost of equity using CAPM, except that there are some slight adjustments we need to make. So given this example where we have the target debt ratio of 10%, cost of debt is 12%, risk-free rate is 5.6%, the tax rate is 25%. We are interested in calculating the divisional beta. The divisional beta. What is the divisional beta? So once we calculate the divisional beta, then we can calculate a divisional WACC. So based on the beta coefficient, return on stock, based on the capital asset pricing model, return on stock is the risk-free rate plus arrow market minus risk-free rate times the beta coefficient. And in this case, we're interested in the divisional beta coefficient. Right, so what do we have? We have we need to be able to calculate the risk-free rate. We need to be able to calculate the required return so that we can calculate the weighted average cost of capital for that division. All right, so this is an example for which we are given a divisional beta of 1.7 and the market risk premium of 6%. So if we do that, if we have all of this information, we are interested in calculating this. And then for that division, we have this as well. So we're interested in calculating the required return of stock for that division. We are given the required return of debt for that division. So we are trying to calculate WACC. So we are given the weights as well. So this targeted debt ratio tells us that there is a 10% debt. So this company has just debt and equity. So which means that the weight of debt is going to be 10%. So if the company is holding just debt and equity, it means that the weight of stock is going to be 90%. All right. So if we have all of that, then we can calculate the cost of equity. And then once we calculate the cost of equity, we can calculate the weighted average cost of capital for that division. So we can see that we have the risk-free rate that is given from the example. So this risk-free rate is 5.6%, 5.6% plus market risk premium. So all of this is the market risk premium, which is 6%. So this is plus 6% times the divisional beta, which is given as 1.7. Okay, so that is going to leave us with 15.8%. And then we know now that the WACC for the division is going to be weight of debt times cost of debt minus taxes, because we need to adjust for taxes, plus weight of stock times cost of stock. So the weight of debt is given as 10%, which is 0.1. And the cost of debt is given as 12%. Then we need to adjust for taxes. Tax rate is 25% minus 0.25, plus the weight of stock is given, which is 0.9. It is 90%. We just calculated the cost of equity, which is 15.8%. And if we multiply out all of that, we'll have 15.12%. So that will be the WACC for the division which we are interested in. So it's almost similar thing to how we calculate the WACC, weighted average cost of capital, for a company. But when we come to a division, we just make certain adjustments so we can get divisional cost of stock. And if we are given divisional debt, so for a division, there is no preferred stock given, so we don't bring preferred stock into the WACC formula. We can easily calculate the WACC, which is the weighted average cost of capital for a division, which gives us 15.12%. All right, so that brings us to the end of this chapter. Thank you.